Okay, so first things first, we're going to define what financial accounting is. Okay, where you're recording, summarizing, and reporting a business's financial transaction. Right, colleagues? Recording, summarizing, and reporting a business's financial transaction. Colleagues, who needs or who uses this financial information? Do we know who needs or uses this financial information? The banks, ZRA, okay, investors, okay. Those are the few people who can use this financial information, okay. So the first thing that we're going to look at is the concepts or some of the principles in accounts. So we're going to start with the first concept here, which is the periodical concept. In simple terms, the periodical concept is just saying this: when you are producing, especially like financial statements, you have to produce them after a certain time period. All right. This time period can be a year, okay, it can be per quarter, all right. But basically, it's just telling you that there should be a time period that is specified whenever you're producing any financial information. Colleagues, any questions on that periodical concept? Are we okay with that? Mr. Peter, Madam Yande? Okay, wonderful. The next is the going concern concept. Basically, which is just saying that when you set up a business, you're not setting it up for a short period of time. Okay, you want it to last for as long as it can. That's what the going concept is, all right? Whenever someone starts a business, the purpose is for the business to stay there for a long time. Okay. Are we okay with the going concept? The going concern concept? Yeah. Yes. Yes. Next, we've got the dual aspect. All right. Basically, for every transaction, on average, two accounts are involved. All right. Every financial transaction that occurs, two accounts most of the times are going to be affected. Sometimes you have financial transactions where there are three accounts, right? But on average, two accounts will be affected, and the amount has to be the same on both accounts for each financial transaction. So when we start learning double entry, that's where the dual aspect concept is going to be applied. But basically, here, what it's just telling you is for every transaction, two accounts are going to be affected. Okay, like for example, here you buy a car on credit, the asset account, that car is an asset, so the asset account will be affected. Since you bought the car on credit, so it means you're owing somebody, so your liability account is also going to be affected. Okay, colleagues, any questions on that one? So this dual aspect, okay, good. All right, thank you. So yeah, so this dual aspect, especially when we're doing double entry, that's where you're going to see it apply. Okay. Then we've got the realization and the accrual concept. The realization concept, what it's saying is revenue is recorded when it's earned, but not when money is received. Okay. So, for example, if you sell a good to somebody on credit, meaning they don't give you money, all right, they just promise you they'll pay you. All right. So, if you sell a good to somebody on credit, you have to record that you've made that sale there. And though you haven't received the money, you have to record that sale. Okay, that's the realization concept. Okay, so revenue is recorded when it's earned, not when money is received, but when it's earned. Okay. Any questions on that one before we move there? Okay. Then the accrual concept. Expenses are recorded when they are incurred and not when they are paid. Okay. So for example, if you're a business and an expense falls due for the month, let's say rent, okay, and you do not pay that rent, you go into the next month, you will still record that you incurred the rent expense, even though you haven't paid it, but you still record uh, that expense. Any questions on the accrual concept? I would say most of the time. I won't say 100% of the time. Sometimes these expenses, all right, maybe if there's a rate applied to the expense. If you don't pay in 1 month, you'll be charged this amount. If you don't pay in 2 months, you'll be charged this amount. Sometimes it might not be fixed, but most of the times, yes, these expenses are the fixed expenses. All right. As I said, yes. Okay, then we've got the matching concept, okay, which is just combining the accrual and realization, which is saying expenses are recorded in the same period as the revenue they help to generate. Okay. Expenses are recorded in the same period as the revenue they help to generate. Right. So this concept, you will see it applying. Just hold on. Hello. Recording. Mm-hmm. Okay. Yes, meaning if you incur an expense in January and you also generate revenue that same January, the expense you incurred must match the revenue. Okay. So this matching concept, you're going to see it when you look at the trading account. Okay, when we're deducting sales minus cost of goods sold. Okay, that uh, illustrates this matching concept. Any questions? Mhm. So you're saying, does it affect anything if the revenue recorded is for another month? Uh, th- for another month, there will be a big effect. There's going to be a big effect. You always have to match the expenses. So if at the end of the year, right, those expenses are incurred that year and that revenue has been incurred that year, okay, and that revenue must match the expenses that have been incurred for that. Okay, for basically what I'm basically saying is like if you're selling a chair, okay, the costs and all the expenses that you incurred when making it, when you sell that chair, it must match the revenue, those costs. When that chair is sold, the cost for making that chair must match the revenue made from that same chair if it's in the same month, basically. So if you don't match the expenses and the revenue, I think there might be a mismatch somewhere. Okay, there might be a mismatch. Maybe your balance sheet won't balance eventually, or you get the wrong profit. You've got another question, so I can still ask if I haven't fully answered your question. Is that Mr. Chipoy? So are you there? Okay. Okay. The prudence concept. Okay. So being prudent, you have to be cautious. You have to also be honest. So it means do not overstate any income or the value of assets in the bid to keep some extra money, basically. Okay. Do not, or even understating expenses, overstating expenses. You shouldn't do that. Okay. Because when you do that, that means you're committing fraud now. All right. And with accounts, you're dealing with a lot of people's money. So you have to make sure the way you're dealing with these people's money, you're exercising a lot of caution. Okay. You do not overstate any income that's made. If you've made a 1,000 that year as revenue, you record it. If you've made a loss that year, you record it as a loss. Know that you've made a loss, then you record it as a profit. Okay. So basically, the prudence concept is just be honest, cautious, accountable, and transparent. Any questions on prudence concept? Okay, we've got the consistency concept. So when you use the same accounting methods every time, do not change. Right? For example, like when you're calculating depreciation, There, you can either calculate using the straight line method, reducing balance method, or the other methods. So if you choose one method, continue using that method. Don't use one method this year, the next year use another method, then the other year you change. No. Basically be consistent. Okay. If you use one accounting method, it should be until use it forever. Unless you're told, okay, stop using this method and then you have to change, then yeah, you can change. But use the same accounting methods every year, basically. Any questions on that one? Okay, money measurement concept. Okay, so only transactions that you can measure with money are the ones that we're interested in. Okay, if it's a transaction, let's say I think a barter exchange, there we are not interested in such type of transactions. Okay, want transactions where it can be measured in monetary terms. Okay, because accounting is basically mostly about numbers. All right. So only transactions that can be measured with money are the ones we that that the accountants are interested in. That is the money measurement concept. Any questions on the money measurement concept? Materiality concept, where you can ignore small errors, small omissions, or small amounts. Okay, as long as they do not affect decision making in the business. Okay, so small errors, small mistakes, small amounts of money, they can be ignored. Basically, that's what the material concept is saying. Small errors, mistakes, and small amounts, you can ignore them. Okay, so long as they do not affect decision making of the business. Okay, so let me just give some illustrations here. Okay, for example, in accounts, whenever you get a non-current asset, okay, you use depreciation across its life because depreciation is the loss in value of an asset. Okay, now if you get something like a small dustbin, okay, a small cupboard, you won't need to do depreciation for those. Okay, you won't really need to do depreciation for those. Okay, even a small error in revenue, maybe there's a one quarter error. Okay, it won't really affect a lot of things. Okay, so basically any small errors, mistakes, or small figures, okay, figures which are not that significant, you can ignore. That's what the materiality concept is just saying to you. Okay, any questions on that? Yes, even if you lose a small asset, maybe that same dustbin I was talking about, if you lose it, you might not even need to record the loss of it in your statements. That is the materiality concept. Okay. Okay, business entity concept. Okay, the business is treated separately from the owner's personal finances. Especially this applies to the private limited companies, public limited companies. Sole traders usually you and the business are one, but still more as a sole trader, your personal finances and your business's finances they're treated separately. Okay, so the business entity concept is just saying the business is like an entity of its own. It's its own individual, basically. And objectivity concept. Okay, financial records should be based on verifiable evidence and not opinions. Okay, to be objective is to do things based on facts and evidence. Okay, that's why there's a lot of documentation so that transactions can be verified. Yes, so those are the main concepts. As we go through financial accounting, I'll be telling you, okay, here this concept is being applied. Here this concept is being applied. For now, you need to just remember what they are. And as we go along,